If you own bank stocks and you also have alternatives in your portfolio, private lending funds, private credit, anything in that category, you probably think those are two separate risks. They're more connected than most people realize, and the Fed just started poking at exactly that. Private credit is basically loans made by non-bank lenders, think private equity firms or asset managers, to companies that can't get traditional bank financing. That market has grown to around $3.5 trillion in assets under management, and it's still climbing. Banks lend money directly to these private credit funds who then lend it out again. So the fund lends to a company, but then the bank is sitting behind it the whole time. When you think you're diversified between banking stocks and alternative fixed income, you might actually be holding the same underlying credit risk twice, just packaged under different names on your statement. The Fed picked up on this too, and now they're asking major banks to detail exactly how much of this exposure is sitting on their books. Their own 2025 stress tests found it isn't currently systemic, but regulators actively investigating it in April 2026 is in itself a signal that is worth paying attention to. If you have alternatives in your portfolio, it's worth asking one question your last portfolio review probably didn't. Are these actually different risks or just different labels on the same one? Like, and follow for part 2 tomorrow, where we get into the AI angle of this story, and which is honestly where it gets really interesting.